Nobody taught us this stuff in school. No one sat us down and explained credit scores, compound interest, or why your paycheck disappears before the month ends. That's what this channel is for. The American Wallet. Real money talk, finally. On July 4th, 2025, while most of America was watching fireworks, Congress handed the president a tax bill, and he signed it. The One Big Beautiful Bill Act, officially known as the Working Families Tax Cut, became law. And here's the thing, it didn't just change a few numbers. It made permanent many of the temporary tax provisions from the 2017 Tax Cuts and Jobs Act, which were set to expire at the end of 2025. Without this bill, your tax brackets, your standard deduction, your child tax credit, all of it would have quietly reverted to worse numbers. That cliff got removed, and most people have no idea. Let's talk about what this actually means for you. The standard deduction for 2026 is $1,600 if you're single, $30,200 if you're married filing jointly, and $24,150 for heads of household. Those numbers are now permanent, indexed for inflation going forward. Under the old trajectory, if this bill had never passed, roughly 32% of taxpayers would have itemized in 2026. Under the new law, that drops to about 14%. Translation: most of you are better off just taking the standard deduction and not fighting over receipts. That simplicity has real value. Now here's where it gets interesting, because the bill didn't just freeze the 2017 rules, it added new ones. If you work in a tipped occupation, you can now deduct up to $25,000 of qualified tip income from your federal taxes. This runs through 2028. Servers, bartenders, delivery drivers, this is real money. Overtime pay also gets a deduction, up to $12,500 for single filers, $25,000 for joint filers, though it phases out if your income exceeds $150,000 single or $300,000 joint. If you're a nurse working double shifts or a warehouse worker hitting overtime every week, run the numbers. This could be significant. Bought a new car with a loan after December 31st, 2024. You can now deduct up to $10,000 of the interest you pay on that loan, as long as the vehicle is new, assembled in the U.S., and used personally, not for business. Used cars don't qualify. Leases don't qualify. But if you financed a new American-built vehicle this year, you have a deduction sitting right there that most people aren't claiming. It phases out for single filers above $100,000 in modified adjusted gross income and joint filers above $200,000. Let's talk about SALT, the state and local tax deduction. This one matters if you live in California, New York, New Jersey, or any high-tax state. The SALT deduction cap has been raised from $10,000 to $40,000 for taxpayers making under $500,000, running from 2025 through 2029, after which it reverts to $10,000. It's a 5-year window. Use it if it applies to you. Now, charitable giving. This is the one I want you to pay close attention to, because Congress actually made it more complicated in 2 different directions at once. Starting in 2026, if you take the standard deduction, meaning you don't itemize, you can now deduct up to $1,000 in cash charitable contributions if you're single, or $2,000 if you're married filing jointly. That is brand new. That has never existed before. If you donate to your church, your local food bank, or the Red Cross, you now get a small federal tax benefit even without itemizing. The catch: the donation must be in cash, and it cannot go to a donor-advised fund or a private foundation. It has to go directly to an operating charity. But, and this is the part that got quietly buried, if you do itemize, your charitable deduction now requires you to exceed a floor equal to 0.5% of your adjusted gross income before any of it counts. That sounds small. On a $100,000 income, that's $500 you have to give away for free before your deductions start registering. It's not catastrophic, But it's a new friction that didn't exist before, and high earners who give heavily to charity need to recalculate their strategy. One more. And this one is for anyone over 65 or anyone whose parents are. From 2025 through 2028, taxpayers age 65 and older can claim an additional $6,000 deduction on top of their standard or itemized deduction. That's $12,000 if both spouses qualify. It phases down for individuals with modified adjusted gross income above $75,000 or $150,000 for joint filers. This is meaningful money. If your parents are retired and haven't heard about this, call them after you finish watching. So what should you actually do right now? First, figure out whether you'll itemize or take the standard deduction in 2026. The math has shifted. Second, if you received tips or overtime in 2025, talk to whoever does your taxes about how to capture those deductions properly. Third, if you give to charity and you don't itemize, make sure your donations are going to operating charities, not donor-advised funds, so you can claim that new $1,000 or $2,000 deduction. And fourth, if you're 65 or older or filing jointly with a spouse who is, make sure that $6,000 bonus deduction is on your return. The law changed. Most people won't know until they either miss a deduction or their accountant mentions it in passing. You know now. That's the whole point of this channel. If this helped even a little, hit subscribe. If it didn't, hit subscribe anyway. Maybe the next one will. See you in my next video.